So we've discussed net present value, or NPV, as a means of comparing various projects, but we want to improve on that a little bit by introducing the profitability index. So this technique improves on the NPV. How? Well, by comparing the NPV to the amount of capital that needs to be invested in the project. So let's get even more specific now and define profitability index as being, on the numerator, the NPV plus the initial investment, and we're dividing that by a denominator, which is the initial investment. So once we calculate a profitability index, we want to look at whether or not it's greater than or less than 1. So if it's greater than 1, then the project will create value for the company. If the profitability index, however, is less than 1, the project will destroy value for the company. So we want to think about the profitability index as being one more common metric that we can use to compare projects for investment. We want to also think about it as an improvement on just looking at the NPV. So it's great to understand this theory, but now let's see how we can apply it in Excel to a real example. So we're back in the Excel template, and as you may have guessed, we're on the tab labeled as Profitability. This should be a relatively straightforward assignment. As you can see, we've already gone ahead and calculated things like NPV and IRR. We're just looking for you to complete the profitability index for one project, and down here for the second project, Project B. So good luck with this assignment, and we'll see you soon. So as we mentioned, this should have been a relatively straightforward assignment in this particular tab here. So let's calculate now the profitability index equals. Let's open up a bracket. We're going to take the NPV here. We're going to want to add the initial investment. So we're going to put in a minus sign. So if we subtract this negative number here, that'll be equivalent to adding. We're going to close the bracket and we're going to divide by the initial investment. But again, let's put in a minus sign so that we can flip the sign of this to positive. And we're going to hit enter there and we get 1.67. It's our profitability index. We have a checkbox over here and it's also showing 100%. So let's go ahead and calculate the profitability index. Similarly, down here equals, we're going to open up the bracket, NPV minus this initial investment here, close the bracket and divide by negative that initial investment there. We're going to hit enter now and we get the second profitability index. So it's great that we've calculated these figures, but more importantly, how would we use them to help us? Well, first of all, if we look at these two projects, very similar NPVs. In fact, if we were just using NPV, it might be hard to choose between the projects. Now we look at the profitability index. Both profitability indexes are higher than 1, so we know that both projects are creating value, but this one is substantially higher at 1.67 versus this one at 1.07. So we would end up choosing project A over project B if we only had sufficient capital for one project. So let's now discuss the most common capital allocation metrics. First of all, we've talked about net present value. It is by far the most used metric for companies in order to select different projects. And remember that this can be calculated by either using the NPV or XNPV functions in Excel. Now, we just discussed also the profitability index, and remember that this is an improvement on the NPV analysis. So the PI, profitability index, can be added to analysis in order to improve on the NPV. And together, the NPV and the profitability index can be used by companies to make informed decisions about capital allocation. Now, even though they are less common, let's remember that many companies also include other metrics. These would include the internal rate of return, or IRR, payback period, and also the discounted payback period. So what we want to do next is go back into Excel, not to perform calculations, but to use some of these metrics to help us make informed decisions. Now, as you can see, we're back in the Excel template. We're on the tab labeled as A/B. Pretty straightforward assignment here. We're just asking you to calculate the NPV for one project and for a second project below. But really the focus here is not the calculations, but the decision-making process. So we're going to ask you some questions about these projects, about whether or not the company should proceed. Now we want to read the situation up here. The company has adequate discretionary capital such that it could invest in both projects below. Well, what does that mean? It's going to have choices to make. It could invest in both projects. It could invest in project A or project B, or none of them. We're also going to ask you to go ahead and complete the tab labeled as C/D. And in this situation, the company only has sufficient capital to invest in one of the projects. So it could invest in C or D, but not both, or it could invest in none of them. We're going to ask you to do these calculations down here for these three metrics for both projects, and then answer some questions about them. Good luck. So let's start out, first of all, with project A. Relatively straightforward here. Remember, a very, very common mistake in this case would be to start the NPV function like this. Remember, we don't want to discount what's in year 0 at all. We want to start our discounting in year 1. So what we're going to do is we're going to say, we're just going to grab that cash flow from year 0 plus NPV, open the bracket, the rate is here, 15%, comma, and now we want to start with year 1 all the way to year 10, close the bracket, and hit enter. Now that we've done that calculation, let's save some time. Just do a simple copy and a paste down here. We're going to tap F2 to assure that it's working. It looks perfect, and we're done. So based on just this simple metric here, we know that this negative NPV would destroy value for the company, but this positive one would create value. So the company would only advance with project B and not project A. Let's hop over to tab CD now and take a look at the solution here. All right, let's start by putting in a very similar formula here for NPV equals, it's negative cash flow. We're going to say plus NPV, open the bracket. The rate is here 15, comma. Let's grab the cash flows from year 1 all the way to the end, close the bracket, and hit enter. Now for the IRR equals IRR, open the bracket. We're just going to grab all of the cash flows like this and hit enter. And now for the profitability index equals, open bracket, the NPV, and we want to add the investment. So we're going to subtract this negative cash flow here, close the bracket, divided by negative this figure here, and we're going to hit enter. Now to save some time, let's take these three formulas, copy them, and we're going to paste them down here. We have all the check boxes over here. So now let's analyze the results. So let's remember up here that we said that the company only has sufficient capital to invest in one project. So which one to choose? Well, we can see here that the NPVs are very, very close, almost equal in fact. So we want to look to the profitability index. We can see that both are above 1, but this one is substantially higher. So we would definitely be choosing project C here. Well done. Now, we definitely understand that the idea with corporate finance is to maximize the value of a business. And we've completed the first section of this course on capital investment. Now we're focused on capital financing. So we've decided which projects we want to either proceed with or avoid. Now we're looking at how to finance them. So what mix of debt and equity are we going to use to fund the projects that we've decided to advance? Now you can see in the notes for capital financing that we're looking to optimize a firm's capital structure. Well, what does this mean? Well, we want to have the lowest possible weighted average cost of capital, and we'll be discussing that in this section of the course. So we want to make sure we understand the difference between enterprise value and equity value. So enterprise value is essentially the value of the entire business, whereas equity value is the value shareholders would receive if the company is sold. And you can see in our diagram there, the difference between enterprise value and equity value is the market value of the company's net debt. So how could we go about calculating the market value of equity or the market capitalization? Well, we would simply take the share price and multiply that by the number of shares outstanding. And once we'd completed that calculation of equity value, we could use that to get enterprise value. And the way that we would do that is we would take equity value, we would add net debt, and that would then give us the enterprise value or the net present value of the entire business. So let's now discuss capital financing, which is the type of funding which is used to finance the purchase of an asset or a project or an investment. And we can use any mix of equity and debt. Now, we've already discussed the idea that investing in new projects increases the assets for a company. Well, this would then mean that the liabilities and or the equity of that company would also need to increase. So in the earlier part of the course, we looked at capital investment. But now if we're considering the mix of debt and equity, we're now talking about capital financing, i.e., where the money comes from. So our focus now needs to be on the mix of debt and equity. For instance, we may choose to finance a project using more debt than equity, or we may also decide that it's better to use more equity than debt. Our focus needs to be on this balance and how to calculate what is optimal for the company and its shareholders. So let's discuss now the business life cycle. And you may have seen a diagram like this before, where a business transitions from initial launch through growth all the way to maturity. And we've graphed some line items like sales, cash flow, and profit, for example. Let's take this diagram now and understand that obviously as the company grows towards maturity, the business risk is dropping during that time. What we're interested in now, though, is how its access to debt funding increases. As the business risk drops, lenders are more willing to lend capital to the company, so the debt funding access increases over time. We'd like to introduce a term that you're likely to encounter called the capital stack. And when we discuss how to optimally finance various capital investments, the capital stack really refers to the optimal mix of equity, debt, or a mix of the two. For example, in order to finance a business, the company may have senior debt, some subordinated debt, and then some equity. You can see that these pieces of capital are often stacked vertically, hence the name, the capital stack. And on the top, we're showing the lowest risk investments like senior debt, going down to the highest risk investments at the bottom like equity. So let's now discuss the various types of equity. If we pull in the same diagram that we looked at previously, we want to focus in on the equity section. By far the most common two types of equity would be preferred shares and common shares. Now, if we start at the bottom with the common shares would be the last liquidation position and the last dividend position. So what does this mean? Well, if the company was liquidated, all the debt holders would be paid first, and then the equity providers would then be paid. And amongst the equity providers, it is the common shareholders which would be in the last liquidation position. Now, as you probably have guessed, preferred shareholders are in a higher liquidation position than common shareholders and also have a higher dividend priority versus common, hence the name preferred shareholders. Now here we want to discuss the various sources of equity, and we can divide these sources into private markets and public markets. Starting with public markets, we could have equity investments from retail investors or individuals wanting to go and purchase a share in or shares in a company. We could also have institutional investors, and they would be purchasing larger blocks for the funds that they're managing. Now moving over to the private markets, that's where we could have sources of equity from original founders of companies, or we could also have funding from venture capital firms or private equity firms. And in the next discussion, we're actually going to focus in on the venture capital and the private equity firms. So if we continue our discussion on the sources of equity and focus in on private equity firms, we can understand that they manage funds or pools of capital that invest in companies where they see an opportunity for a high rate of return. Now keep in mind that these funds invest only for limited time periods. They're always trying to look for exit strategies, which could include an IPO, which is an initial public offering, or they could sell to another private equity firm. The private equity funds typically are split into two categories. Now, these two categories include venture capital funds and LBO funds. Now, the venture capital funds would typically invest in early stage businesses or expanding businesses that have limited access to other forms of financing. Examples of venture capital funds would be Sequoia Capital, Y Combinator, or Anderson Horowitz. And now LBO funds would typically invest in more mature businesses. They usually take a controlling interest and they will leverage the equity investment with a substantial amount of external debt. The buyout funds tend to be significantly larger than the venture capital funds. And here examples of LBO funds would be Blackstone, KKR, or the Carlyle Group.